Welcome back. The Canadian dollar once again today has traded over 72 cents US. That's its highest level in 5 months or so. This, of course, is versus the US dollar. Let's talk to an expert about the currency and where it may be going from here and why it's going where it's gone so far. Jayati Bharadwaj is in New York about what's driving the currency. He's global currency strategist at TD Securities. Jayati, thanks a lot for joining us. The rally in the Canadian dollar is very much primarily a story of the decline in the U.S. currency. Is that fair to say that the fundamentals are really on the U.S. side of this equation?
Hi, thank you so much for having me. And I agree with what you said. And there is definitely a reason as to why the Canadian dollar is benefiting along with a lot of its peers in G10 markets. It definitely has to do with the fact that there has been a broad-based dollar decline across the board. In fact, if you look at how dollar tends to behave in times of increased uncertainty, a pickup in global macro vol, then the dollar in all of those times historically has strengthened and has behaved like a safe haven. But that has not been true for the past few weeks, particularly last week, where you saw, in fact, currencies like the euro behave a lot more like safe haven than the dollar. Even in a week when, markets were, trying to deal with a lot of uncertainty, a lot of announcements back and forth, global equity markets came crashing down. The US dollar did not see the flows that it has historically seen during times of turbulence. In fact, the dollar took a massive leg lower, and we think that indicates a very massive sentiment shift in the minds of investors as to whether the dollar is a safe retreat or not.
In the minds of many investors, the U.S. dollar not playing that safe haven role might be a result of perceptions that the U.S. government, the U.S. executive branch, the White House, is initiating a period of extreme disruption in the global trading order. Is that a fair interpretation to reach?
Yes, absolutely. So it is definitely one of the biggest drivers that this time around, it is the US which is driving a big shock to the rest of the world. And one other big factor at play is that for the last 3 years, I think most of the people have been used to a very strong and exceptional US market, where US growth has been very strong. US equities have massively outperformed their global peers, which kept driving massive inflows into the US markets and kept the dollar so strong and overvalued. But that has all come to change in just a span of a few months, where the Trump policies are, creating concerns about US growth. Markets are adding to expectations of Fed cuts. But more importantly, the rest of the world is now trying to step up their fiscal spending. We saw announcements out of Germany and Europe. They're trying to do be a lot more self-reliant than they have been in the past. China potentially will also have to come out and announce a lot more fiscal stimulus to shield the global growth shock. And this is making people fall out of love with US assets, which is why even in the flows, you can see that global equity flows have been pulling money away from US markets and actually have been parking money into Germany and Asia as of late.
One thing that has happened in this market sell-off is that U.S. bonds have sold off as the U.S. stock market has sold off. What is that telling us about the embrace of international markets of the U.S. dollar?
I think that has been one very big puzzling question to all of us last week, which also then links to why the dollar is not behaving like a safe haven anymore. Because traditionally, during times of extreme market stress, you would see, let's say, even if equities go down, you are used to a time when, US bond markets would rally instead of crashing. But that's not been the case. There have been some rumors going around in the market that potentially China and some other, global trading partners are trying to sell US Treasury so that then that gives them dollars to sell. That's one potential theory out there, but there's no way for us to verify that yet. But definitely that's been one big puzzling question. But that, to me, as someone in the FX world, just highlights another reason as to why investors are sort of like falling out of love with US assets, and they're not treating the dollar as a safe haven that it used to be. In fact, they're looking for investments outside of the US, both in equity and bond markets, and sort of as a flight to safety, which is very unique and something that we've not seen in a very long time.
So one of your pieces of of advice to investors who invest in the currency market or trade in the currency market is that you expect the US dollar to continue to weaken against major international currencies for the remainder of 2025 at least. And you think any rallies against currencies like the euro, the Australian dollar, the New Zealand dollar, and the Mexican peso are selling opportunities in the short term?
Yes, we do think that the dollar weakness will definitely continue in the second half of the year, particularly once the Fed starts cutting interest rates. They could start cutting interest rates rapidly at every single meeting, but we think that that will be backloaded in the second half of the year. The only thing I'm a little cautious of in the very short term is maybe a slight bounce back in the dollar before it starts heading lower again. The only reason for that is markets right now are extremely bearish the dollar. They are very, very worried about US growth, but they are sort of have lost track of where the rest of the world growth has headed. Markets are not seem to be focused on growth in China and Europe, which actually will also get hurt as the longer the trade uncertainty drags. But markets right now have only been primarily unilaterally focused on US growth and have been very optimistic about growth in China and Europe and other parts of the world. But if hard data starts showing you the opposite picture, then you could see some bounce back in the dollar before it starts heading lower again. So we're just cautious of that bounce back, but that bounce back should give you better entry levels to engage in a more medium-term dollar bearish view.
Okay, so by extension, I infer that you expect the Canadian dollar to rise from here, correct? The Canadian dollar as measured in US currency.
So the Canadian dollar has actually been benefiting not just from the dollar weakness, but also the fact that tariffs on Canada were not as stringent as we expected. In fact, Trump seems to be targeting mainly non-USMCA compliant goods, and Canada, for most part, most of the trade between Canada and US should end up being compliant within USMCA. It's just a matter of the exporters registering their goods as such, which can take about a few months to a quarter or so. So depending upon the time as to where you can establish that most of the trade between the two countries falls within USMCA, that should help the Canadian dollar. The only thing I'm watchful for is USMCA negotiations, because that ultimately is the end goal for Trump administration. If those conversations start picking up and they don't happen to go as well as the last week has, then that could start to add a little bit of a volatility back into Canadian dollar. So I'm just watchful of that. But the second half of the year, I think, should be a great time for the Canadian dollar to rally. You'll have local elections out of the way. The Fed would be cutting interest rates. The interest rate gap between Canada and US will start to converge more rapidly, and that could be a great environment for the Canadian dollar to rally.
Jayati, thank you so much for this insight. Jayati Bharadwaj is global currency strategist at TD Securities.